Now we're going to talk a little bit about what's going on in the market here, what's going on in the marketplace, and the bank failures. So, we have the Silicon Valley Bank, I think Signature Bank in New York.
Yep.
Silicon Valley Bank was the 16th largest bank in the country. It's a big one. And Signature Bank was a big one. I read they had $110 billion in deposits, bank deposits. That's pretty big. And now you have Credit Suisse. That's a big issue. They're probably going to go belly up in Europe. So you're going to have this ripple effect. So what's going on with the markets?
Paul, I don't think they're going to go belly up Credit Suisse, because I think the Swiss, I just read somewhere before our call, the Swiss bank is helping them out with $50 billion.
Oh, nice.
Yeah. So I think that
the rescue plan is coming in.
Plan's there, I believe I read.
Which should be good, right? Because we don't want too much contagion. We already have it. The good thing is mortgage rates have dropped down to 3.55 or 6.55 from 6.76. So we're seeing that. And that's just a flight to quality going to bonds, right? There are people getting into the 30-year T-bond, the 10-year T-bond. So that's helping, and that should continue to help, but we'll see. We'll see. We can't have the Fed continue to pound on increasing the rate, because what caused these bank failures, besides horrific management at these banks, when they keep increasing these rates, that's the cost to borrow from the banks, from the Federal Reserve. That's the cost, what it costs them to borrow. So now they have to make greater and greater returns on their money, on what they're investing in, because for every dollar we put in as a depositor, they can borrow 10 against it.
Correct.
So they tried to do a lot of T-bonds, and that's where they lost. With the 30-year Treasury bond, they were only worth 60, 70, 85 cents on a dollar, with the rates continuing to go up. So they got hurt with that. And Silicon Valley Bank also had made horrible investments in wind and solar, these green energy companies, which just don't make money. They're just failures right now. It just doesn't work right now. And when you're putting all your eggs in one basket, you should fail. That should happen. You can't do that.
It was poor risk and asset management liability, basically, from the Silicon Valley Bank for the most part. It was interesting. I read, I think one of their chief administrative officers was a former CFO of Lehman Brothers that went under.
Yes, I read that too. Yeah. So you're bringing somebody who failed a company at one place, now he's failing again. Eventually, somebody should not hire this person.
Yeah.
You would think you get somebody with fresh, better ideas out there. But anyway, it's going to impact the housing market, and maybe a positive way and also in negative ways, because you're eventually going to have unemployment. Unemployment's already going to start to creep up with job losses in different sectors. The tech sector is just
you've been seeing in tech sector for about 6 months now, almost. It feels like
totally ravaged. The unemployment numbers are still showing good, but it's kind of like a shadow employment, right? Because you have a lot of people just dropped out of the workforce that aren't employed. And you have growing population.
There's different metrics. There's the headline, which is called U3. And I think there's another one that doesn't account for people that kind of gave up. It's called U6 that the Fed tracks as well, but it doesn't get published in the headline news, essentially.
Yeah. John Williams from shadowstats.com has those if anybody's interested. It's a paid site, but he does have good info on what's going on there. The layoff numbers, just to run through it real quick, and it's something for you and I to know, Mike, because this is 6 to 9 months impacted down the road, and great for the audience to know here too. The layoff numbers from December, January are mirroring 2008 layoffs. That has me really worried, big time. And that's something that's not being talked about at all in the mainstream. So I'm very worried about that, because those are our potential buyers, right? So what does that mean as investors, what we have to do? So now we got to shift more to wholesaling, where you're selling to other investors, which means
it's a lot easier to understand, going back to the last deal with Midland, what the world looks like 3 months from now than 6 to 9 months from a rehab perspective. So it's a model that we've been shifting to a lot. It's maybe take a little less profit dollars, but a lot less work and a lot less risk, because it's a quick churn.
Yes, totally. So the holding costs can eat you up if you're holding these things too long. So with deals like that, that's what we're looking for. That's what Mike and I are targeting right now. We're trying to teach our students, target these types of deals where you have a spread. You don't want to go in there and in a market where it's going up, you can go in there, and people they were catching everything that's going to the upside. You're doing fine. But when we're going in a reverse direction, you just got to be more and more conservative with everything, right? You just got to protect yourself as much as possible.
Yeah, every month of interest payments eats into gross profits. Every mistake in rehab now in a non-increasing market eats into gross profits. Whereas the past, if you make a mistake on a rehab in a rising market, no biggie, because you're going to make it up on the sales side.
Totally. And I want to give you an example of a deal my son had found last summer. We closed on it in August. And this is what can happen. And Mike, you know a little bit about this one in Flossmoor, Illinois. We had 3 buyers. One went on, came off. They turned out they weren't approved, or the bank just canceled it. Another one couldn't get the funding. And then the third one on here is now just being delayed. Their buyer's solid. Everything is good. They actually, the roof had a couple leaks in there. So what they did is they went in and had the roof repaired because they're that confident they're going to close on it. But everything's just been delayed. It's been delayed so much that the interest expense of holdings property, because it was $205,000 property, is $15,000. So they say bye-bye to all the profits. So there'll be no profits made on this property.
Yeah.
For my son's first deal, just because of holding costs. But this is what can happen. This is why you need to be protected. The market was better then. And so I didn't shift my numbers. And you rarely have 3 people drop off. Like we had delays. We've had a lot of delayed what do you call it? Just went off. We've had a lot of delayed closings, but we haven't had too much fall off. If you want to talk a little bit about that, I switched my battery.
Yeah, sure. Yeah. So, with certain rehabs, again, that's a risk you run, especially on the higher dollar rehabs. If you're getting private lending funds of 10, 12% from your private lenders, that adds up to, just on every 100K, and it's at 10% to 12%, that's 10 to 12K a year. So if you're only budgeting, 6 months, you're expecting, 6K, call it a year, potentially, or 5K a year in private lending fees. Now that rehab took even longer, another 12 months, that's another 5, 6K that eats into your net profits on top of all the other holding costs like electric, water, everything else that you have. Totally. And usually when rehab goes that long, that means something else popped up. And it's like a snowball effect, essentially. Your rehab budget's overblown. All your holding costs are now overblown. And your gross margin, you thought you were making 50K on a deal, might be 10 to 0 quickly.
Yeah. In 2008, I learned that lesson very well. I had one that was going to make around 35K in Lansdale for selling it for 315. The whole crash happened. The people lost their jobs. So they no longer had a mortgage. It sat on the market for 7 additional months after that. I sold it for 255. Huge drops. You don't want to catch falling enough. I end up losing 45K on that one. Another one I lost 65K on. So there's deals where you'll get that, where that happens. That's what we're trying to protect you from, that kind of a deal.
And that's where your experience comes into play, Paul. You lived through that. It was tough times, and that's what people get when they kind of send us deals and want to work with us on some joint ventures with rehabs and wholesales. You get that level of experience being through those cycles.
Yeah, those battle scars, they go deep. I got a lot of scars, a lot of wounds from that back then. So I just don't want that to happen to people. Yeah. So we're here to protect you, and that's why we're shifting, and we're constantly looking at what's going on in the data between Altos, which does a great job in giving us weekly data, because we are seeing inventory still falling. It is still falling. So with falling inventory, I think it's down to 418,000 this past week. With falling inventory, normally this is the time of year when people are listing. Which brings me to another article I just read, the accidental landlord. You and I have talked about this, Mike. There's people that have the 3% mortgage, like I have on this house. They're 3 to 4% mortgages. They don't want to sell their house because now they can rent it and cash flow it if they want to move somewhere else.
Yeah.
So if anything, they're pulling a HELOC from it for down money to buy the next place, right? Because they're still going to cash flow this property. So that's
smart for them too, right? It's you're adding another asset to your portfolio as an individual, and I don't blame them. But that, like you said, it's going to go into that inventory conversation. A house that might have gone into the market in the past at a normal interest rate environment, that ain't happening as much when you got 2-3%.
Right. So you got headwinds and tailwinds, people that were hoping for this monster inventory coming out. It's probably not going to happen unless there's monster job losses, and people absolutely have to sell, because people don't want to sell this cheap debt, because that ends up being an asset for them. So we're thinking, Mike and I both have the mindset we're still going to have low inventory probably at least for the next 6-12 months or so. We'll see what goes on next year. May still be that way unless we have massive unemployment, massive job losses. That changes everything, right? But we can't plan on that. kind of plan on what you see, what is in front of you, and what can we project. We can't project massive job. I just don't see that right now. Could happen, but
yeah, like you said, continue to monitor the data and then make decisions quickly when something's changing. And that's the name of the game with real estate here.
Yeah, you got to look at it every quarter. And right now we're at the point where you got to look at your numbers every month. Normally a quarterly check works. Now you got to do a monthly check. What's going on in the market? Stay in front of everything. There's so much data. There's so much information. Get off Redfin for free. Redfin has great data. Altos Research, just go look them up on YouTube. And then I don't really put too much stock in the NARS numbers. That's National Association of Realtors, because they count pending inventory as inventory available, and it's not available. It's pending. It's off the market, right? I don't know why they lump it together. So I don't like the way they put their numbers out there.
You got to try to treat it separately. I agree.
Yeah. So keep your eyes on that. And if you're interested in learning more, reach out to us. We'd love to have a conversation with you. We'd love you to join REO Auction Academy. Anything else in closing, Mike?
No, I think it was a good call today. Do some deal reviews for everyone, and we'll keep these up every week as we got plenty of inventory and plenty of deals to share.
Yep. And we have some deals coming up that are going to be hopefully closing over the next month or two, and we will go through the numbers and what exactly happened from beginning to end on those. Yep. All right, guys, we will catch you on the next video.